Welcome to Module 1, where we'll explore the basic legal concepts essential to real estate investment. This module covers key topics such as property rights, ownership contracts, zoning laws, mortgages, and title protection. Understanding these foundational elements is crucial for anyone looking to invest in real estate, as they ensure you know your rights, responsibilities, and the legal framework surrounding property transactions. Let's dive in and build a solid legal foundation for your real estate investment journey. Today, we'll cover some essential topics that will help you navigate the legal side of real estate investing. First, we'll dive into core legal concepts that every investor should understand. This foundation will give you the clarity you need when dealing with property transactions. Next, we'll explore how different ownership structures influence your rights and decisions when it comes to transferring property. Understanding this can greatly impact your investment strategy. Finally, we'll discuss why regulations and protections are in place and how they work to reduce your risk as an investor. By the end, you'll have a practical legal framework to make smarter, more informed property decisions. Property rights are really the foundation of ownership when it comes to real estate. These rights give you the legal authority to possess, use, control, transfer, and even exclude others from your property. First, possession means you have a lawful claim to the property, so you're recognized as the rightful holder. Control means you get to decide how the property is used, whether that's living in it, leasing it, or developing it. Transfer is about your ability to sell, lease, or pass ownership to someone else. It's important to remember that ownership isn't just about physically holding the property. It's about having a set of enforceable legal rights that protect your interests. This legal reality is what really defines ownership in real estate investment. When we talk about ownership in real estate, it's important to understand that it's not just about physically possessing the property. Ownership is really a bundle of legal rights that come together. Let's break down these rights. First, there's the right to use the property. This means you can occupy or improve the property as long as you follow the law. Next is possession, which gives you legal occupancy. You have the right to hold the property. Then comes exclusion, which allows you to keep others out unless you've legally granted them access. Control is another key right. It means you decide how the property is managed, leased, or maintained. Finally, there's disposition, the right to sell, transfer, or even gift your ownership rights to someone else. Understanding this bundle of rights helps clarify what it really means to own real estate and how each element plays a role in investment and management decisions. When we talk about sole proprietorship as a form of ownership, it's important to understand that one individual owns the property outright. This person makes all the decisions, whether it's purchasing, leasing, financing, or selling. Because there's only one owner, control is fully centralized, which can make managing the property straightforward and efficient. However, with this simplicity comes significant responsibility. The owner is directly tied to any contracts, debts, or obligations related to property. That means if there are any legal claims or financial losses that exceed the property's value, those liabilities can affect the owner's personal assets. This unlimited liability is a key risk to keep in mind. Sole proprietorship is often the best fit for straightforward holdings, where one investor wants to move quickly without the complexity of partnerships or corporations. It offers direct ownership and control, which appeals to those looking for simplicity in their real estate investments. Let's talk about joint tenancy, which is a specific form of shared ownership. In joint tenancy, each owner holds an equal share of the property, meaning everyone has the same level of ownership. One important characteristic is that the ownership interest is undivided, so no one physically owns a specific portion. They all own the property as a whole. A key legal feature of joint tenancy is the right of survivorship. This means if one owner passes away, their share automatically transfers to the surviving owners, rather than being inherited by heirs outside of the joint tenancy. This automatic transfer helps avoid probate and can simplify the ownership transition. To create a joint tenancy, for unities must be present. These unities are time, title, interest, and possession, meaning all owners acquire their interests at the same time through the same document with equal shares and equal rights to possess the property. Finally, joint tenancy is commonly used in real estate investment because it provides a clear method for ownership and transfer among co-owners. Understanding these core legal features is essential for anyone considering this form of ownership. Here, we're looking at the concept of tenancy in common as a form of property ownership. This structure allows multiple investors to own the same property, but each holds a separate legal interest. That means the ownership shares can be equal or unequal. So one investor might own a larger portion than another. Another important point is that each owner can sell or transfer their share independently without needing approval from the other co-owners. This flexibility can be useful for investors wanting to adjust their holdings without affecting the entire group. However, unlike some other forms of ownership, there's no right of survivorship here. That means if one owner passes away, their share doesn't automatically go to the other owners, but instead is passed on according to their will or estate plan. So, with tenancy in common, you have shared property but clearly separate interests, which can be an effective way for multiple investors to participate in real estate investments while maintaining individual control over their shares. Here, we're looking at spousal ownership, which is a specific form of property ownership available only to legally married couples, provided it's recognized by state law. One of the key features is the right of survivorship. This means that if one spouse passes away, full ownership of the property automatically transfers to the surviving spouse, which can simplify inheritance issues. Another important aspect is creditor protection. This ownership often shields the property from claims against just one spouse, reducing certain financial risks for the couple. The form of ownership discussed here is called tenancy by the entirety, where both spouses hold the property as a single legal entity, particularly relevant in real estate investment contexts. When we talk about real estate contracts, there are 5 essential elements that make an agreement valid and enforceable. First is the offer, where one party clearly proposes the terms of the deal. Next comes acceptance, meaning the other party agrees to those terms without any changes. Third is consideration, which refers to something of value being exchanged between the parties, like money or property. Fourth, the contract must have a legal purpose, so the subject of the agreement has to be lawful. Finally, the parties involved must have the legal capacity and authority to enter into the contract. These 5 elements together ensure that the contract is both binding and valid. Let's focus on the key sections of the purchase agreement, which are crucial for controlling risk in any real estate transaction. These are the clauses you want to read first because they essentially determine what the buyer pays when the deal closes and under what conditions either party can back out. First, the purchase price clause states the agreed upon amount, the deposit terms, and how the funds will be paid at closing. This section lays out the financial foundation of the deal. Second, contingencies are protections for the buyer. They cover important conditions like securing financing, passing inspections, appraisals, and completing due diligence. If any of these aren't satisfied, the buyer can walk away without penalty. Third is the closing date, which sets the deadline for the transfer of the property's title, the release of funds, and possession by the buyer. This ensures everyone knows when the transaction will be finalized. Finally, the title and remedies clause explains the required quality of the title. It also outlines what happens if either party fails to meet their obligations, including any remedies or penalties. Understanding these sections helps manage risk and ensures a smoother transaction for both buyers and sellers. Zoning laws are a fundamental part of real estate investment because they set the rules for what you can and cannot do with a piece of land. Essentially, zoning determines the allowed uses of the land, whether it can be residential, commercial, industrial, or a mix of these. It also controls the scale of development, including the number of units you can build, how much of the lot can be covered, the building height, and parking requirements. Lastly, zoning influences the placement of structures by specifying setbacks, buffers, and access rules. These regulations are critical because they shape the potential and limitations of property even before any construction begins, making essential knowledge for any investor. Let's take a closer look at the different zoning classifications that shape how land is used. First, we have residential zoning, which covers areas designated for housing, including single-family homes, apartments, and multifamily living spaces. This classification is all about where people live and the types of residential structures allowed. Next is commercial zoning, which focuses on retail spaces, office buildings, and hospitality uses like hotels and restaurants. This category is crucial for business activities and services that serve the community. Then we have industrial zoning, which is geared towards manufacturing, warehousing, and logistics operations. These areas support industries that contribute production and distribution. Finally, mixed-use zoning combines both residential and commercial functions within the same area. This approach promotes vibrant neighborhoods where people can live, work, and play all in one place. Understanding these zoning classifications helps us navigate how different areas are planned and developed, guiding everything from real estate investment decisions to community growth strategies. Let's talk about mortgages and how they secure a loan. A mortgage is essentially a legal agreement where the lender holds a claim against real property, that's the house or land, until the borrower fully repays the debt. This claim acts as collateral, which means the property itself is what secures the loan. When someone takes out a mortgage, they're making a promise to pay back the loan under agreed upon terms. If the borrower fails to meet these repayment terms or defaults, the lender has the right to enforce the agreement, often leading to foreclosure. So, in summary, a mortgage ties a loan to real estate, ensuring the lender has protection while the borrower commits to paying back according to their agreement. This mechanism is fundamental to real estate investment. Every mortgage payment is made up of three key components that are both legal and financial in nature. First, we have the principal, which is the amount you originally borrowed to buy the property. When you make a principal payment, it directly reduces the outstanding loan balance and simultaneously builds your equity in the property. Next is the interest, which is essentially the cost of borrowing money from your lender. This interest can be fixed, meaning it stays the same over time, or variable, which means it can change. The interest rate you pay has a big impact on the total cost of your loan over its lifetime. Finally, we have the terms of the mortgage. These are the rules that govern the loan's repayment, including the length of the loan, the schedule of payments, the structure of the interest rate, and any penalties that might apply. These terms influence the cash flow for investors and the level of risk involved. Together, these components shape every mortgage payment and play a crucial role in real estate investment decisions. When we talk about title and title insurance, the key idea is understanding ownership and protection. A title is a legal proof that shows who actually owns a property and what rights come with it. This is critical because when you buy real estate, you need to be sure that the person selling it has the legal authority to do so. Title insurance comes into play as a safeguard for both the buyer and the lender. It protects against any hidden claims, errors in public records, or undisclosed defects that might surface after the sale is complete. These issues can jeopardize ownership or financial security, so having insurance provides peace of mind. At closing, the documents you sign do more than just finalize the sale. They officially recognize your ownership of the property. Ensuring you have a clean title helps reduce risks and keeps the transaction smooth and straightforward. In short, own your property clearly and protect your investment legally. Title insurance is an essential part of that protection, making sure that what you think you own is yours without hidden surprises. Let's talk about common title defects, which can cause delays or complications in property transactions like transfers, financing, or resales. Any cloud on the title, they call it a title defect, can be a significant issue. Often, these defects remain hidden until there's a sale, refinancing, or an insurance claim, at which point they come to light and can create major headaches. One common problem is liens. These might be unpaid taxes, contractor claims, or court judgments that attach to property, meaning the owner might owe money that has to be settled before the property can change hands. Encumbrances are another category. These include easements, restrictions, or covenants that can limit how the property is used. For example, you might not be able to build or develop the land as you wish because of these legal limitations. Ownership disputes are also a big concern. Sometimes competing heirs, divorce settlements, or even recording errors can lead to challenges over who really owns the property. These disputes can slow down or even derail transactions. Boundary issues are about uncertainty regarding property lines. Survey conflicts or encroachments, where one property's use intrudes on another, can make it difficult to know exactly where the true property boundaries lie. Finally, recording defects refer to paperwork problems, like missing signatures, forged deeds, or mistakes in filing. that can break the chain of title, making ownership unclear or questionable. All of these title defects are important to identify and resolve because they impact real estate investments and the security of property ownership. Understanding these issues helps protect your transaction and investment from unexpected legal troubles. Title insurance is a crucial protection that guards against hidden title problems that may surface after closing on a property. Without title insurance, any issues like old liens, fraud, recording errors, or disputes over ownership become the responsibility of the buyer or lender, potentially leading to costly legal battles, unexpected expenses, and delays in the property transfer. On the other hand, when you have title insurance, the policy covers legal defense and any covered claims. There are two main types of policies: owner's policies, which protect the buyer, and lender's policies, which protect the mortgage holder's interest. This insurance significantly reduces financial risk both at closing and after the purchase, making it an essential part of any real estate investment. When we talk about liens and encumbrances, it's important to understand how they affect property ownership. Although they don't always prevent someone from owning a property, they can definitely limit how the property is used, transferred, or how much it's worth. A lien is essentially a legal claim on the property, usually because of unpaid debt. This means someone else has a financial interest in the property until that debt is resolved. On the other hand, an encumbrance refers to any restriction or burden on the property. Examples include easements that allow others to use part of the land, covenants that impose certain conditions, or setback requirements that limit where structures can be built. Both liens and encumbrances can reduce your flexibility with the property. They often make selling it more complicated, affect financing options, and limit development potential. A key idea to remember is that physical constraints on a property often hint at underlying legal constraints. Recognizing these factors is crucial when evaluating real estate investments. Before finalizing any real estate investment, it's crucial to conduct thorough due diligence on several key areas that can significantly impact the value, risk, and transferability of the property. First, confirm the clear title and legal ownership, and check for any easements, liens, or transfer restrictions that might complicate the sale. Next, look into zoning and land use to ensure the property's permitted uses align with your plans, paying attention to setbacks, density limits, and any pending zoning changes that could affect its future potential. Then, inspect the physical condition thoroughly. Evaluate the structure, its systems, property boundaries, environmental concerns, and any deferred maintenance that might require immediate or costly repairs. Finally, review all financial obligations associated with the property, including current leases, taxes, insurance, HOA rules, debt terms, and ongoing operating expenses. By carefully investigating these factors, you turn assumptions into informed decisions, protecting your investment and minimizing unforeseen risks. When it comes to managing legal risks in real estate investment, there are several key strategies to keep in mind. First, always run a title search. This step is crucial to confirm legal ownership and to uncover any liens, easements, or other claims that might affect the property before you finalize the deal. Next, order a professional inspection early on. This helps you identify any structural, safety, or system-related issues, giving you the chance to renegotiate terms or even walk away if necessary. Another vital point is to put every term in writing. Clear, detailed contracts should define the price, contingencies, deadline, disclosures, and remedies to prevent any misunderstandings. It's also important to carry the right insurance. Title, property, and liability coverage protect you by transferring financial risk away from you as the investor. Lastly, verify zoning and compliance carefully, ensuring that the property's intended use, renovations, occupancy, and permits all align with local regulations helps you avoid costly legal problems down the line. Together, these strategies build a strong foundation for reducing uncertainty and protecting your investment. In this module, we'll explore the regulations and compliance that govern real estate. Real estate operates within a complex, layered legal system that influences how property is used, transferred, financed, and disclosed. At the local level, regulations focus on land use and permitting. This includes zoning laws, building codes, occupancy rules, inspections, and local tax assessments. These rules determine what can be built where, how properties can be occupied, and ensure safety standards are met. Moving up to the state level, the emphasis shifts to property law and licensing. Here, you'll find laws governing ownership rights, the enforcement of contracts, foreclosure procedures, and the regulation of brokers and lenders. These laws protect property owners and buyers alike, while ensuring professionals in the market operate fairly. At the federal level, regulations focus primarily on disclosure and fair treatment. This includes laws on fair housing to prevent discrimination, environmental requirements to protect our surroundings, lending disclosures to keep buyers informed, and anti-discrimination standards to ensure equal opportunities for all. Understanding these layers is essential for anyone involved in real estate investment or transactions, as compliance with these laws helps protect your interests and promotes a fair, transparent market. Legal protections play a crucial role in supporting investment success, especially in real estate. When investors have clear rights and can insure against risks, they gain the confidence needed to move forward with their investments. This confidence makes financing easier and helps protect the long-term value of the property. A clear title is essential because it verifies ownership and reduces the risk involved in transferring the property. Enforceable contracts are equally important, as they define each party's obligations, set deadlines, and establish remedies in case of disputes. By having these protections in place, investors face fewer costly surprises. Conducting thorough due diligence and having appropriate insurance safeguards their returns, helping ensure a smoother investment experience overall. This legal framework is what underpins successful, secure real estate investment. Let's review the 6 key legal concepts that shape how investment control, risk, financing, and transfer work in real estate. First, property rights define control. Ownership isn't just about having a title. It includes the rights to use the property, exclude others, lease it out, and transfer those rights. These define what ownership really means in practice. Second, the ownership structure matters a lot. Whether you hold property as a sole owner, joint owners, or shared owners influences liability, how transfer rules apply, and how decisions get made. Third, contracts are crucial for allocating risk. Well-drafted contracts with clear terms and contingencies, along with full disclosures, protect both the parties involved in the deal and the investor's interests. Fourth, zoning regulations can limit potential. Things like permitted uses, density restrictions, and other local rules directly impact property value and strategy, so they must be carefully considered. Fifth, mortgages secure lenders by defining loan terms, repayment responsibilities, and consequences if there's a default. These factors shape financing risk and influence the investment stability. Finally, title insurance plays a vital role by protecting ownership. It guards against hidden defects, liens, or claims that could jeopardize the transfer of property. Understanding these 6 concepts is essential for managing real estate investments effectively and minimizing risk throughout the process. Before you commit to any deal, there are 5 crucial steps you need to complete to ensure you're making a sound real estate investment. First, confirm ownership and thoroughly review the title report to avoid any surprises. Next, check the zoning laws to make sure your intended use is allowed on the property. Third, carefully read the contract, paying close attention to contingencies, deadlines, and any disclosures. Fourth, stress test your financing by evaluating the rates, terms, and potential cash flow to ensure the deal makes financial sense. Finally, document all your due diligence before signing any agreements or transferring funds. Remember, legal clarity comes first, and your investment decision follows. Taking these steps seriously will help protect your investment and set you up for success.